The modern stock market often looks like a high-speed casino. Millions spend their days sweating over charts, trying to guess what a ticker will do by next Tuesday, pulling their hair out in constant anxiety. Most people assume that winning this game requires a genius-level IQ. They believe success comes from using complex math to outcompute every other person on the trading floor. Even Warren Buffett, the world's most successful investor, started his career following this exact same pattern. He began as a speculator, trying to predict the unpredictable. Treating the market like a short-term lottery is a powerful trap that frequently snares even the most brilliant minds. At age 11, Buffett began an 8-year obsession with technical analysis, convinced the key to wealth was hidden in price charts. This mechanical view acted as a broken compass, focusing his energy on surface-level fluctuations, rather than the underlying reality of the businesses. He eventually realized that a high IQ is a liability when applied to a flawed framework. A standard IQ of 120 provides all the processing power an investor needs, as long as they possess the correct perspective. Raw intelligence is ineffective in investing if the person's fundamental viewpoint is based on gambling rather than a long-term assessment of value. Buffett's perspective changed when he realized stock shares are literal pieces of physical businesses. This shift moved his focus away from squiggly lines and toward tangible assets with real-world utility. To understand this, imagine the stock market disappeared tomorrow. The ticker symbols vanish and the exchanges close their doors indefinitely. Without a daily price quote, you evaluate investments like buying a farm, looking at its ability to produce profit over time. A rational farmer focuses on the long-term harvest and crop yields, completely ignoring whatever daily price a neighbor might offer for the land.
For a true owner, daily stock market fluctuations are merely noise that has zero impact on a company's underlying operations or its long-term output. A sudden market crash exposes the sharp divide between these two opposing viewpoints. The speculator views a price drop as a personal crisis. They react with panic, seeing the falling numbers as proof that their wealth is evaporating. The farmer looks at the same crash and smiles. If you own a productive farm and the neighboring land suddenly goes on a 50% off sale, you view that as an opportunity to expand. You excitedly buy more acreage because you know the land's ability to grow food hasn't changed. Viewing stocks as physical assets turns market volatility into a distinct competitive advantage. It allows an investor to remain calm while everyone else is selling in a frenzy. A market crash provides a rare opportunity to purchase highly productive businesses at a steep discount. This strategy works because the long-term yield of the entire economy tends to grow. Just as a single farm becomes more productive with better tools, the aggregate of all businesses grows more efficient as society innovates. For over 2 centuries, the American economy has functioned as a massive engine for compounding this collective efficiency. This steady increase in productivity is what builds widespread wealth. Look at John D. Rockefeller, the wealthiest person in modern history. He held a level of financial power that is almost impossible to imagine today. Despite his billions, Rockefeller lived a life that was physically more difficult than the average life today. He lacked basic healthcare, modern transportation, and digital technology. Rockefeller had to travel to a freezing stadium to watch a game. Today, almost everyone can watch that same game in high definition from their own home. This leap in quality of life is the direct result of thousands of businesses becoming more efficient over time, a process that creates more value for everyone. When an innovator like Thomas Edison creates something new, that efficiency becomes a permanent part of the economy. These advancements compound, creating a legacy of value that lasts far longer than any individual life. History includes severe setbacks, such as the Great Depression, pandemics, and wars. These moments cause real, widespread economic pain. The historical record shows that society's capacity for innovation has consistently overcome even these extreme disruptions, maintaining a steady climb in overall productivity. Successful investing relies on aligning your capital with this long-term growth in human productivity. It is a commitment to the idea that businesses will continue to find better ways to serve people. Building wealth involves matching your finances with the long-term advancement of human capability. This alignment provides the confidence to remain calm and focused while the rest of the world is distracted by the noise of the market.